Lasagna Brown here with LKB Enterprises. Today I am interviewing a real estate professional. He's a lender, Raymond Noble. Hi Raymond, how you doing?
Man, I'm doing unbelievable today. How about you?
I'm doing good. So, I want to give our viewers a better understanding about lending when they're getting ready to purchase a home. So Raymond, what company do you work for?
I work for NEXA Mortgage. It's the largest mortgage broker in the country. We have over 1,600 brokers nationwide, and we are approved with about 182 different lenders to date.
Okay. And only in California or
nationwide?
Nationwide. Okay, so if you're looking for a lender, I'm supposed to give you the 411. So listen up, guys. Okay, so I do real estate. I'm a real estate broker. He does lending. Anytime you're ready to purchase a home, you should speak to your lender. Have your ducks in a row. It's always best to have your loan approved prior to shopping, because you don't want to just window shop. If you find a home, you want to be able to purchase that home. How can a buyer get ready to purchase a home, and why is it important to have the pre-approval prior to shopping for a home?
That's a good question. There's several reasons why you want to be pre-approved first. One of which is, let's say that you find the house that you love and you'd love to have your family live in. You wouldn't be able to write an offer until you had an approval, because the listing agent is not going to accept your offer unless they know that you have the ability to close. So there's no way for you to prove it unless some lender has looked at your information, your bank statements, pay stubs, W-2s, tax returns, done an income calculation, looked at your credit, and he's going to certify that, yes, I've looked at this information and you are approvable for a certain dollar amount. Without that, the seller would be taking a chance that you don't qualify, and it could be 30, 45, 60 days down the road, and then he finds out you can't close, so he wasted a lot of time, energy, and money. So they're always going to ask you for an approval letter.
Okay, a lot of my clients are hung up on having to put 20% down. Is it necessary for a first-time home buyer versus an investor? Is it necessary to put down 20%?
Okay, that's a good question. I have a client actually right now. They're buying a brand new home in a new home subdivision, and they are putting 10% down. So they have a first mortgage, which is 80% of the sales price, and they have a second mortgage, which is a line of credit, which is 10% of the sales price. So they're only bringing 10%, and they have a 80% first, a 10% second. And by doing that, you don't have any mortgage insurance, so your payment is effectively less than it would be if you put 10% down.
Okay, so when you put less than 20% down, can you tell us a little bit about PMI, the premium mortgage insurance?
Sure. The point of mortgage insurance is not to ensure that you get money if something happens to the mortgage at the end. That insurance is to protect the lender against you going into foreclosure, so that they don't lose all of their money. So they make you pay for an insurance policy because they're not requiring you to put down 20%. So you can get actually as low as 3.5% using an FHA loan. And you will have mortgage insurance, which is 0.85% of the loan amount, and that's part of your monthly payment. However, it does allow you to buy a house with only 3.5% down. And that doesn't even account for other programs, like there may be some down payment assistance programs that you could qualify for. So you could, in essence, buy a house and maybe only have to come up with $1,500, $2,000 cash out of your pocket to close. So it pays to have a good real estate agent, so they write a good contract. That way that down payment assistance money can go a little further, which means that you have to come up with less money.
Okay, so what credit score should a potential buyer focus on having? Because I know that some think that they have to have a 700 or they have to have a 750 or what's a realistic credit score that a would-be home buyer should aim for?
Okay. So if you're going to use down payment assistance, 640 is probably the barrier. You have to be above 640. If you're going to use regular FHA and you have your own down payment, like I have a client, I negotiated for them to buy the house they were renting, and they had a 580 credit score. I think it was 583 credit score, but they paid their 3.5% down a year ago, gave it to the seller, and so now, and then we negotiated for the seller to pay, X amount of dollars of the closing costs. So in essence, they're going to buy the house with $10,000, and that'll be their cash out of pocket. So to answer your question just real specifically, FHA will go to 500 credit score. As long as you can get an automated approval, they will take it. But that's straight FHA, no down payment assistance. If you want something with down payment assistance, you're going to have 640.
So there's a lot of different types of loans. So far, we've talked about investments loans. You've talked about an 80-10-10. We've talked about an FHA loan, 3.5% down. That's primarily for first-time home buyers, and it has to be an owner-occupant loan. Can you tell us the different types of loans there are?
Sure. Our company we have a lot of different lenders. So we have hard money, which is probably the highest rate loan out there. And that's for people who are investing in real estate, where they're going to buy a house, they're going to fix it, and then they're going to sell it. It's a short-term loan, maybe 3 to 9 months, maybe 3 months to a year, depending on the construction process. That rate might be 9 to 13%, just depending on the borrower and their credit and all of that. That's one end of the spectrum. On the other end of the spectrum is your Fannie Mae, your Freddie Mac, your Ginnie Maes, your USDAs. Those are going to be much lower interest rates. Down, we got something going on over here. So those are going to be much lower interest rates. Then we have what's kind of new to the market, which is a loan called a DSCR, debt service coverage ratio. So what that means is, if a person is buying an investment property and the mortgage payment is $2,500 and the rent is $2,500, they will allow that 1-to-1 ratio and allow you to buy it as long as you bring the down payment, which could be 20%. And so you don't have any other income qualifications other than what the rent is for that house in that neighborhood. In that neighborhood, and that's it. So credit score, rent.
That's a great loan. I didn't know about that one. In recent years, the last few years, I have been really pushing for my clients to consider purchasing a 1 to 4 unit as their first property, as opposed to a single family residence, because they get the benefits of the FHA first time home buyers, but they can utilize the rents from the other units to assist them in qualifying. And then it's easier to come up with 3.5% down on a larger purchase, and your investment purchases
20%.
But you're paying on a lower amount.
Yep.
So can you speak to that point as far as so that they understand?
Yeah. So when you're looking at an investment property, let's say a fourplex. A fourplex might cost, say, $700,000. So that would be 20% down. That's $140,000 that you have to bring to the table just for down payment. Whereas if you do FHA and buy it as an owner-occupied unit, then you can come in with $21,000. It's a little more than 21, but I'm just using 3%. So 3.5% of $700,000 is,
we could do the math,
10 grand, 20 something $1,000, right? That's a big difference. 20,000 to
140,000.
That's a big difference. So, and you get to use the rent from the other tenants as part of your qualification as far as income. So you don't have to qualify for the $700,000. You may only qualify for $300,000, but you you get to be, now your tax returns say you're an investor. So now the next property you buy, if you want to buy another investment property, is super easy because you already have tax returns saying that you're an investor. So, and you probably would be living there for free or very close to free.
Yeah.
So you wouldn't have a payment. So now life changes if you don't have to make a mortgage payment. And, now you get to stack your money and go do it again. Go stack your money and go do it again. Stack your money and do it again. I wish somebody had told me that or changed the way I thought when I first bought my home. And I probably would have done that too.
Yeah.
When I was young and I didn't have kids and other responsibility, I could have just stayed there. I only had to stay there for really 6 months. And then you could move out, buy another property, and go on to the next one. So that's an excellent way to start, especially young folks buying a house. Go buy a fourplex. Don't be, don't try to be shiny. Let your finance be shiny.
There you go. So it is not
Duplex, triplex.
fourplex, duplex, triplex are the investment properties that will qualify. 5 units or more is commercial, so we'd have to stay under the 4 units. That would
For that, yes, absolutely.
For the FHA, the 3.5% down. So we've talked about we've covered a lot. This is Raymond Noble with NEXA Mortgage.
Yeah, I work at NEXA Mortgage. I've been in the mortgage business for 30 years, and if we can help you, give us a call.
What's your phone number?
Our number is 916-712-4554. What's your number?
My name is LaSonia Brown, LKB Enterprises, 209-605-9859. If you have any questions, reach out. I'd love to assist you in finding your next home, and I'm sure that Raymond will be able to assist you with any lending needs.